one thing that policymakers are concerned about is the interaction between a strategic Bitcoin reserve and the U.S. dollar, and particularly U.S. dollar dominance. So, one question here we've got to ponder is, and we'll go to Josh on this, is what's the interaction between sort of like the dollar stability and a strategic Bitcoin reserve?
Well, I think when you think about the United States more generally, I think, first of all, it's kind of, Matt mentioned this a little bit, but it kind of starts with the framing, right? So the United States government already owns a lot of assets, right? So they own gold, they own land, they own, we have a strategic oil reserve. We have these kinds of things that exist already. And I think that one way that you could frame a lot of those assets is you could think about those just in terms of their option value, right? So if you're thinking about the balance sheet of the United States, and you're thinking about the sort of unprecedented level of debt that we're seeing now, one option that the U.S. government has is they could sell off some of these assets, right? It could sell some of its gold, or it could sell some of its land, or something like that, if it found itself in a position where it needed to pay off that debt and tax revenues weren't sufficient. I think that is actually kind of the right framing then to kind of think about why you might want to hold a Bitcoin reserve. The idea is that it's sort of like a hedge against yourself, right? Your own behavior. So the idea here is that, if the United States reaches a point where its debt becomes unsustainable, they're not going to default in the sense that they just, tell everybody, hey, we're not going to pay back these bonds. They're going to default by sort of inflating away that debt, right? So they're going to resort to inflation to kind of pay down the debt. And so when you do that, real assets are going to tend to appreciate. Assets that are in fixed supply, assets that are hard to produce, right? Those things are going to tend to appreciate in value as a result of inflation, right? People want to avoid the detrimental effects of inflation, so they're gonna move towards real assets. So if you think about Bitcoin, you would expect that in that inflationary environment, that Bitcoin would perform very well. And so if you're the United States government and you have Bitcoin on your balance sheet, like one sort of potential benefit here is like you're sort of hedging against your own potential irresponsibility, right? So if you accumulate too much debt and the Bitcoin price rises, then that's increasing the option value of that Bitcoin. And so then you can potentially sell off the Bitcoin to pay down some of the debt. But in the process, this might actually make the debt more sustainable in the first place, right? If people recognize that this is what you're doing, then it will tend to adjust their expectations about the sustainability of the debt. And we'll probably talk about, the costs, I guess, like a little more later, but, you do need to be careful about how you do this because, it sort of matters how you shape people's expectations. But I think that's the general idea here is that, you're holding some asset that is sort of hedging against the risk of unsustainable debt.
And to jump off that too, I think to dig into here is how Bitcoin is also different from some of the existing reserve assets that the U.S. is holding. And Matthew Ferranti here has published a great report, sort of differentiating Bitcoin from these other assets. So Matthew, could you just give us a little bit of information on that? Like how exactly is Bitcoin different, and is that a good thing or a bad thing?
Yeah, so Bitcoin is just structurally different than many other different things you could invest in. There's no central issuer, there's no monetary policy, or I guess there is one, but it's sort of fixed and predetermined. There's no capital controls, and so that differs it kind of from all the fiat assets of foreign currencies and things like that, stocks, bonds. But also it's different from gold in the sense that Bitcoin also has this built-in payment network and validation system that just doesn't exist with gold. If someone hands you a bar of gold, or they tell you it's a bar of gold, you don't have any way of, you'd have to take them at their word. I mean, there's obviously chemical and physical procedures you can go through to try to validate it. Those are very costly and time consuming. But with Bitcoin, there really isn't that kind of doubt, because you can validate it very quickly through the Bitcoin blockchain. And obviously there's nothing stopping people from setting up, some kind of bootleg version of Bitcoin, but everybody will understand that that's not sort of the real Bitcoin, because it doesn't run off of the same piece of software. So that makes Bitcoin different from gold, as well. Just the fact, of course, it's digital, right? It's not a physical commodity. And so, for those reasons, just the structural differences, I think we see that the price of Bitcoin is relatively uncorrelated to the price of many of these other assets. I mean, obviously these correlations shift around over time, and they can be higher or lower depending on the macroeconomic environment. But there does seem to be some evidence that Bitcoin provides diversification benefits against some of these other assets, which is very similar to what Josh was saying.